The S&P 500 opened the trading session down over 2% before bouncing, closing above the 6,000 level, ultimately ending up down only negative 1.46%. But the market just got absolutely annihilated and caught off guard by this huge DeepSeek AI news. This was obviously led by Nvidia, which lost over $500 billion in market cap, which is obviously the biggest one-day loss in US history. But for all the worry and hand-wringing that went on today and the crazy increase in volatility, we really haven't dropped that much, and we're actually in a very natural support zone. You can see this 6,000 level is an area that has served as both support and resistance for the last couple of months, bouncing off of this area, and here we are right back in at this 6,000 strike. This is also our lower dealer cluster zone. This represents an area where market participants are likely closing out their put positions and option dealers are hedging. And so we could see additional support from the options market in addition to the price support that we're seeing in the underlying S&P futures and in the SPY ETF. When we look at the gamma exposure data here highlighted by the purple bars, we see most of this is actually skewed positively to the upside. And if we just scroll up a little bit, we can see the positive gamma exposure goes all the way up to 6,400. And so even though we are currently in negative gamma exposure just slightly, the skew is still to the upside, at least on the S&P 500. I will note that we do have some volume coming in here at some of these lower strikes. For example, the 5,500 strike, we did see some notable volume in the options market coming in. We also have this pretty sizable gamma exposure concentration at the 5,800 strike. This obviously matches with the recent low we saw earlier in January. So that's also something to be aware of. However, we think the skew in the options market is still to the upside for February. Switching gears to the Qs just getting absolutely rocked today, down over 2.5%, trading around 515 here in the post market. We're right in our lower dealer cluster zone, and we see volume is pretty fairly dispersed in a normal bell curve pattern. So we're not seeing anything extraordinary from the volume data. The one caveat to that I would note would be at the 500 strike. We do see this is our second largest gamma exposure concentration on the downside, and we actually had over 200,000 contracts traded at that 500 strike today. So there are, of course, quite a bit of market participants that feel there is further downside, or at least they're looking for some protection in case of further downside here on the Qs. So that's my main concern in terms of the broad market index ETFs. The Qs do look slightly more negative than the S&P 500. So that's something to just watch out for. And we see the 500 strike also matches up with some previous support and resistance zone. So we could have a little bit of further downside to go in the Qs, and that's obviously representative of mega cap tech and the DeepSeek AI news that hit over the weekend. Next, let's take a look at Nvidia. Nvidia, obviously the headline stock of the day, getting absolutely obliterated, down over 18% at the lows of the day. Bouncing back, we actually took a long position near the lows today, more of a speculative play, with the idea being that the largest gamma exposure concentration is still at the 150 strike, believe it or not. This is an area that we've tagged multiple times over the last couple of months. And so if this move today is a dramatic overreaction, we want to take advantage of any bounce that could ensue back at least to the zero gamma exposure level. And so while there could be further downside to go, we've positioned ourselves to take advantage of a potential move back to the zero gamma exposure level. We still had quite a bit of volume coming in, everywhere between 120 and 150 in the options market. We still have gamma exposure concentrations all the way up to the 155 strike. And so from a risk reward perspective, taking a low risk, high reward type of approach makes a lot of sense. And so this was a play that we added into our portfolio. We actually took the February 21st expiration. We did an option strategy that will give us exposure up to the 135 strike. So right up in here, if we can get back up into that level, we'll make a nice profit. By the way, if you're interested in checking out our portfolio in our community Discord, I'll put a link down in the description below. So ultimately, I don't know if Nvidia is going to have enough juice to get back up to the 150 level anytime soon, but I think a move back into the zero gamma exposure level around 135 does make sense for a potential bounce, at least in the near term over the next 3 to 4 weeks. Not everything was doom and gloom today. If we take a look at Apple, actually up over 3%, trading back into the 230 level. We actually got a pretty nice bounce off of the 220 level a few trading sessions ago, and this was a previous support right around the election time, which led to the huge rally we saw up through the 250 level. We still have large gamma exposure concentrated at the 250 strike, and I think there is potential for a move back into that level sometime during Q1. Apple does have earnings coming up on Thursday, so there is an added element of uncertainty with the earnings release, but I think in the long term, market participants are going to continue positioning for a move higher, and we can see that from the volume data between 220 and 260, and we also see a lot of positive gamma exposure between the 230 and 260 strike. So this is another name that we're looking to add an option strategy on to take advantage of a potential move higher in Apple. Next, let's take a look at Google. Google, another name getting hit hard today, down 4%, trading around the 192 area in after hours. This is a name we've played a number of times. We've seen the gamma exposure and the volume data at the 200 strike remain an important data point over the last 2 months, and you can see every single time there's been a dip down to this 190 level in Google, there's always been a rip back up into this 200 strike. And so we've tagged that level multiple times. We actually took advantage of the volume and gamma exposure data that continues to come in at the 200 strike. This is another interesting setup to me. I think from a low risk, high reward standpoint, this looks to be a decent entry point for a move back up into that 200 strike. So we'll be looking at something like an iron butterfly or potentially a call debit spread targeting that 200 strike and beyond, as we actually see gamma exposure growing at some of these higher strikes as well, both at the 205 and 210 strike. We see gamma exposure growing, so there could be an actual breakout above the 200 strike depending on how earnings go. Google has earnings on February 4th, so make sure you factor that uncertainty into your probability assessment. And if you guys are interested in accessing our gamma exposure dashboard and our option flow analytics tools, head on over to geeksoffinance.com. We are running a promotional offer, $300 off our yearly portfolio manager tier subscription. Use code WINTER2025 at checkout. We only have a few spots available, so definitely check that out when you get a chance. Members also get access to our premium channels in our community Discord. We've got a ton of great traders in there sharing their own strategies and trade ideas, and we discuss a number of different market strategies related to GEX every single trading session. You definitely don't want to miss that. Check out the link in the description below. Thanks so much everybody for watching, and we'll see you guys in the next video.